Welcome to Iron Financial. This is the only place you need to be to forge a stronger portfolio and cut right through all the market weakness. Today, we're putting PriceSmart on the anvil. The company just dropped its latest earnings report, and it sent a real shockwave through the market. So we're here to do what we do best, run a full structural stress test. We are going to find out if this company is built like a fortress, or if it's just a temporary facade that's ready to crumble.
And it all started with this number, $1.62. That's the earnings per share figure PriceSmart just posted for its second quarter. Now, a number in isolation is just a number. But in this environment, where analysts are desperately looking for any sign of weakness, this number didn't just turn heads on Wall Street. It pretty much snapped them clean around. It's our job to figure out exactly why.
Because look at this, they didn't just meet expectations. They didn't just sneak past them, no. They took a sledgehammer to them. The street was looking for $1.57 in earnings per share. PriceSmart delivered $1.62. They were forecasting $1.48 billion in revenue. PriceSmart came in scorching hot at $1.5 billion. This is a clear, decisive beat on both the top and the bottom lines. And this is the kind of report that gets trading algorithms firing and people mashing the buy button. But hold on. Let's pump the brakes. Here at Iron Financial, we don't chase headlines. We dissect them. That beat is just the shiny exterior. We're here to inspect the rebar and the concrete underneath. So, the real question for today is this. Are these numbers built to last? Is this a fundamental shift in the company's strength, or are we looking at a one-time pop that was just fueled by some temporary tailwinds? We're going to find out if this is a real fortress built on solid ground, or just a pretty facade. Let's get to work. So here's our blueprint for today's stress test. We're going to start with that headline beat, then we'll get into forging the top line and checking the foundation of their profitability. After that, we'll examine their expansion blueprint, look for any cracks in the armor, and of course finish with the iron verdict. All right, first up, let's look at how they're forging that top line. When a company beats revenue estimates, you've got to understand the mechanics behind it, right? Is it a real surge in demand, or is it some kind of financial engineering? Well, the raw numbers here show some serious momentum, the kind you just can't fake. Just look at this year over year. Total revenues surged from $1.36 billion to a full $1.5 billion. That's a 9.7% jump. And the core of their business, their net merchandise sales, grew even faster at 9.9%. You have to understand, in this economic climate, posting nearly double-digit growth at this kind of scale, well, that's some serious heavy lifting. This isn't just a minor uptick, this is a significant acceleration in the business's core function, which is, selling stuff. And this chart just brilliantly illustrates that climb. It is a steep, powerful move upwards. You're looking at an increase of about $140 million in revenue in a single year for just one quarter. This visual makes it crystal clear. The sales engine isn't just running, it is firing on all cylinders. But remember, a bigger engine doesn't automatically mean it's a better one. We need to know what's fueling it. Okay, so the growth is there, I get it, but here's my question. Where is it really coming from? Because anyone can grow revenue by just opening new stores. That's what we call checkbook growth. You're writing checks to buy new revenue streams. But is the core business actually getting healthier? Are their existing locations getting stronger, or is this all just an expansion story? We really need to look at the comparable sales. And that's exactly the right question to ask, and the answer is, it's both. That comparable sales number, 7.6%, is incredibly healthy. It proves that the existing clubs are pulling more weight year after year. That's real organic strength. But the real story, the one that points to long-term structural health, is in the membership base. What's so fascinating here is the quality of that membership. They are systematically converting customers to their premium platinum tier. A year ago, it was 14.5% of their base. Today, it's 19.5%. That is a massive shift. These aren't just more customers. These are higher value customers who pay more, and they have higher renewal rates. That tells us that customers are seeing more value in the brand and are willing to pay up for it. And that, my friend, is a high-quality foundation for revenue. Okay, the top line looks solid, forged with real steel, I'll give you that. But the saying, revenue is vanity. It looks great on a headline, but it means absolutely nothing if it doesn't translate down to the bottom line. Profit. Profit is sanity. So let's get our instruments out and check the foundation of this entire structure. Let's talk profitability. And the foundation looks solid. In fact, it looks even stronger than the top line did. Look at the operating income. It jumped from 65.3 million to 75.4 million. That's a 15.6% increase. Now remember, revenue grew 9.7%. When your operating income grows faster than your revenue, that's called positive operating leverage. Think of it this way. Their costs just aren't growing as fast as their sales. It means the business is becoming more efficient as it scales, and every new dollar of sales is generating more profit than the last. That is the sign of a very, very healthy financial engine.
But that's exactly my point of concern. This quote here from BitGet News, it absolutely nails it. Is this a new, higher plateau of profitability, or was it just a one-time pop? Was there something funky in the numbers this quarter, some hidden tailwind or an accounting trick that made the foundation look stronger than it really is? Before we certify this foundation as solid, we need to check for any temporary supports that might be holding it up.
A fair and absolutely critical question. So let's look at the two big external factors, which we've broken down right here. On the tailwind side, yeah, they did benefit from a slightly lower effective tax rate. It dropped from 27.2% down to 26.4%. So that helped the bottom line a little. But now look at the other side of the ledger, the headwind. Because they operate in emerging markets, they booked an $8.7 million net loss from currency issues, which is significantly worse than the $5.1 million loss they took last year. So when you weigh these two against each other, the crucial takeaway is that the headwind was actually stronger than the tailwind. That 15.6% explosion in operating income, it wasn't due to tax benefits or financial gains. It was pure, unadulterated business performance. The foundation is absolutely sound. So, we've established a strong top line and an even stronger foundation of profitability. Now let's move to the blueprints and see how this thing builds. Because a company that is confident in its own structural integrity doesn't just maintain the building, it starts construction on a whole new tower. And let me tell you, PriceSmart is laying a lot of new groundwork.
This map right here shows their current empire. 56 clubs spread across Central America, the Caribbean, and Colombia. They've really carved out a dominant position in these markets where, the whole warehouse club model is still a relatively new concept. They are the established power in this region. They've built a serious moat.
But they are not standing still. This is not a company that's resting on its laurels. Just look at this pipeline. They are in pure execution mode. La Romana in the Dominican Republic this spring, 2 more in Jamaica and 1 in Costa Rica by the end of this year. Another one in Guatemala in early 2027. This is a clear, aggressive, and very confident roadmap. And what's most interesting here is that last line, actively pursuing sites in Chile. That's not just deepening their moat, that's expanding the empire into a major new South American market. This is the definition of a forward-looking growth plan. It's an aggressive build-out, absolutely. But talk is cheap and blueprints can be shelved pretty easily. These pictures, though, they show that this isn't just a plan, it's reality. The ground is broken, steel is going up. But this brings up another critical question. What about the cost? I mean, an expansion this ambitious, it costs serious capital. Is this whole expansion being built on a mountain of debt? Are they leveraging the company to the hilt to fund this growth, potentially putting the entire fortress at risk if there's even one little hiccup?
An absolutely vital question. So let's do it. Let's pull up the balance sheet and run the numbers. They've got total assets of $2.44 billion. Stockholders' equity, which is the true net worth of the company, is a hefty $1.33 billion. Now, look at the total long-term debt, just $163 million. That gives them a debt-to-equity ratio of 0.11. Let me put that in perspective for you. That is rock solid. It's almost nothing. They could pay off their entire long-term debt with about 1.5 quarters of their adjusted EBITDA. So, the answer to your question is a resounding no. They are funding this aggressive growth from a position of immense financial strength. This is not a house of cards. This is a fortress built of pure granite.
Okay, I'll concede the structure looks strong. The revenue growth is real, profitability is impressive, and the balance sheet is a vault. But even the strongest fortress can have cracks. And as we conduct our final inspection, I'm seeing one that's really hard to ignore. It's a red flag that comes not from the numbers, but from the actions of the people who know the numbers best. Insider selling. And this isn't a small crack we're talking about. This is over $2.2 million worth of stock sold by insiders in just the last 90 days. Now look, people sell stock for a lot of reasons. Diversification, buying a house, taxes, whatever. But when you see a consistent pattern of selling from high-level executives right after a blowout quarter, you have to ask the simple question. If the outlook is so darn strong, why are the top executives cashing out millions of dollars worth of stock? And let's be very clear about who is doing the selling. We're not talking about small players here. This is John D. Hildebrand, the
the chief operating officer, the man in charge of the day-to-day business, selling over $1 million worth of his stock. This is Paul Kovaleski, an executive vice president, selling over $500,000. These are the generals on the battlefield. And when they start selling their shares, it sends a powerful signal. You can have the best spreadsheets and financial models in the world, but the actions of informed insiders, that is a data point you simply cannot ignore.
That's a completely valid concern and a significant red flag. And you know what? It's not the only one. There are other hairline cracks in the financials, mainly around those foreign currency issues we touched on earlier. It's a persistent operational risk for this company. Right now, they have over $77 million in cash just sitting in Trinidad and Honduras that they're having a hard time converting back to US dollars. That is cash that is effectively trapped. And while they have a fortress balance sheet, having that much capital tied up is a drag on efficiency and a real risk to cash flow.
All right, the stress test is complete. We've examined the revenue streams, we've tested the foundation, we've inspected the expansion blueprints, and we've searched for every single crack in the armor. So now it's time to lay out the final blueprint and render the iron verdict. Is PriceSmart an opportunity for your portfolio, or is it a trap?
Let's summarize what we forged today. On one hand, you have a fortress. The evidence is undeniable. You have powerful double-digit growth in revenue and even faster growth in profits. That growth is being driven by an improving mix of high-value members. All of this is supported by a clear, aggressive, and fully funded expansion plan, all built on a rock-solid balance sheet with almost no debt. That is the bull case, and it is formidable. But on the other hand, you have the cracks. You have millions of dollars in stock being sold by the COO and other top executives. You have persistent, nagging currency risks that tie up cash and create volatility. And you have that lingering question of whether these record margins are really the new normal.
So, the iron verdict is this. The underlying business is fundamentally strong. This is not a facade. The growth is real, the balance sheet is a vault, and the operational execution is absolutely top tier. PriceSmart has, without a doubt, built an operational fortress. However, the insider selling is a significant warning sign that cannot and should not be ignored. The people who run the fortress are taking some chips off the table. And those currency issues, they aren't going away. They represent a real, tangible headwind.
And this leaves a critical question for every single investor watching right now. When you're deciding where to allocate your hard-earned capital, what do you weigh more heavily? Do you bet on the fortress, the overwhelming evidence of a business that is just firing on all cylinders? Or do you heed the warning from the cracks in the armor, the actions of the insiders, and the persistent risks they have to face every single day? That is the fulcrum on which this entire investment decision rests, and that is what you need to decide.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.